Everything you wanted to know about analyzing a bank stock. You're in the right place, folks, because this is where the money is. Welcome to the show. I'm Matt Koppenheffer. Right here is David Hansen. Of course, we don't care about you, though. Over here is our special guest, Anand Chokkavelu. Anand, you wrote a great article on Fool.com about analyzing a bank stock. We'll get to that, but not quite yet. First, Justin Bieber.
What do you do now?
Accused of attempted robbery. Another, I don't know, nail in the Justin Bieber coffin, you might say. But look, if the Justin Bieber brand was a stock right now, are you buying or selling? Anand?
Depends what it's priced at, but it's probably at a high in these late.
You think it's at a high right now? I feel like the brand has been taking a beating.
It's not a nail in the coffin. This is like another flower blooming.
You really?
This is a good thing.
Yeah. Oh, you think
He's
the attempted
going
robbery is a good thing for him?
He's building a bad boy character. He's going to be in movies, and it's going to be great.
Have you ever seen Justin Bieber? I don't think, no matter how many attempted robberies he does, I don't think he'll ever have a bad boy
He's a
character.
big, strong guy.
But really, he's going to be better at 40 than he is today. See, I like to buy my Biebers pre-YouTube. Buy a basket of them.
Well, yeah. Diversify. It's like a VC Bieber approach.
Exactly.
All right, on that note, let's get to the first headline of the day. First headline comes from CNN Money, and the headline is PIMCO sees another $30 billion drain away. PIMCO has continued to see funds flow out of its bond funds, even more so after Mohamed El-Erian left the company. Bill Gross still there. Bill Gross, founder of PIMCO. Anand, is this in your eyes, is this a issue of PIMCO, or is it just who wants to own a bond fund right now?
That's a good question. I mean, PIMCO, I guess it's partially their success, right? And then when you have key man risk like you do with Bill Gross, all your eggs are kind of in a basket.
Yep.
But yeah, again, like you said, bonds. I haven't seen the latest funds
wants
flow,
to be
but
a bond fund
overall,
millionaire.
Right. So you've got that issue too. But bigger picture, longer term across cycles. I mean, it's hard when you're on top to stay on top, especially when you rely on someone who doesn't play that well with others, it seems.
Unless you're Drake. Hansen?
I think it's probably a bond problem more so than a gross problem, a nasty problem. It's a nice narrative because he's such a unique character. He gets on, does his little podcasts, his little monthly things. He has some interesting similes and analogies. So it's a good story to build it around that it's him, but I think it's really just more of a bond thing. They still have $1.5 trillion in bonds there. So $30 billion, kind of a lot, but put it in perspective. Meh.
I'm going with bond thing.
Okay.
Second headline.
Wait, are we keeping score?
Yep, I won that round. Second headline, Watt's new plan leaves Fannie's and Freddie's investors out. So we've got Mel Watt stepping in with his plan, his view of where Fannie Mae and Freddie Mac are going. And the plan initially excited the investors, and actually the stocks are up today, so it seems like they're still pretty cheered about it, because he tweaked the language a little bit, which made it sound like there's going to be less of a winding down of Fannie Mae and Freddie Mac and more of a maintaining to prop up the housing market, for lack of a better way to put it. However, John Carney over at Wall Street Journal is saying, yeah, they're going to keep them around, but Hansen?
He didn't say anything about the shareholders in the speech. This is very different from what Ed DeMarco, the director of the FHFA, before Mel Watt, was saying. He was all for winding them down. Let's get rid of these things. They failed before. We're winding them down. Now Mel Watt stepping in and saying, hey, maybe that's not the job of the FHFA. We're going to just run these things for the housing market and let Congress deal with winding them down. So maybe that's why people are excited, because they know, as we've talked about, it's going to be so hard for Congress to do anything here, to get anything passed. So maybe they're just saying Mel Watt wants to keep Fannie and Freddie deep in the housing market. Status quo leaves us in the picture, so maybe that's okay. For me, it doesn't really change anything, though.
Anand, do the common stocks of Fannie Mae and Freddie Mac hold any interest for you?
Personally, they're in my too hard bucket, just because it feels more like a regulatory call than a stock call, and
There you go. That is a fair answer. And on that note, third headline. Headline is Getting Fed. Lunch with Ben Bernanke auctioned for $70,500. This was a charity auction that, of course, was the price for lunch with Ben Bernanke. Lunch with Tim Geithner, former Treasury Secretary, went for a bargain, $50,000. Of course, in the past, lunches with Warren Buffett have gone for as much as $1 million. I think more than $1 million in some cases.
That's insane.
Anand, if you were to pay for a charity lunch with some investing or business luminary, who'd you go with, and how much do you think you'd have to pay?
Well, I did some research for this, and I
Okay.
talked to some Wall Street guys, and they said you could eat Tim Geithner's lunch for free, apparently. But
Very nice.
neither here nor there. All right, investing luminary. I mean, of course you'd want to do Buffett, of course. I mean, but
Would you pay $1 million for it?
no. Well, I don't have the money to do that. You know,
Yeah,
not
but-
in disposable liquid.
Right. Oh, okay.
You know. I'm trying to think of a deeper tracks person that would be fantastic. I mean, I got the chance one time when Michael Lewis came to the office.
Ooh.
That was, to me, that was the greatest person who's come into the office that for
Yeah.
me, just as, you know, someone who enjoys writing and it's a hero, sat next to him and the, you know, there was
Sure.
a dozen of us, but got to talk to him a bit. And so for me, that's
One-on-one lunch with Michael Lewis, how much would you pay?
at least $10. I'd cover his meal
Chipotle.
at
Pay
least.
for his Chipotle.
I'd try to charge it through too, but
Hanson?
I didn't know you're putting me on the spot.
Of course. That's what the show's all about.
Does it have to be investing or just business? Like
You're trying to look at my answers.
No, I'm not gonna. You're probably a boring one. I'll go with Zuckerberg. I think it's his birthday this week or something. Maybe he'll take me out for his birthday. I mean, the guy's turning 30 years old. He's got an amazing vision for the future. I'd go with Zuckerberg.
How much would you pay?
Honestly, I'd pay $200.
You'd pay $200 to have lunch with. Okay. Mine are not boring. They're Tom Gaynor, the CIO of Markel. That would be fantastic. Look, Tom Gaynor is the Warren Buffett that we're going to be talking about 20 years from now. 20 years from now, people are going to be talking about this guy the way they talk about Warren Buffett. Manish Pabrai, who is a little known, I think mostly little known, except within value investing circles. He runs a hedge fund. Very sharp guy. Got a great Buffett-esque kind of view towards what he's investing in. I think it would be cool to have lunch with him as well. As a value investor myself, keep it to around $500. I'd pay $500.
Taco Bell?
A whole lot of
Make it
Taco Bell.
breakfast.
We would have fajitas like you don't even know.
That's good.
All right.
Well, let me add to my answer. Tim
Yes.
Cook, I think, would be really interesting if we're talking about folks. And I would pay a share of Apple, whatever the market price is.
Oh.
Like lobster, market price.
Interesting. You'd be getting a
So
really,
currently like almost $600 right now.
you'd get a serious value deal on that if he took you up on that, because I think lunch with Tim Cook has gone for $600,000.
Well, yeah, I get a discount.
You get a discount. Okay. A 100x discount.
Right.
All right, going on to the focus for today. We've got you here in the studio, Anand. You've got this article out on Fool.com. All the WTMIers should read this article. It was really a good read. Why don't you walk us through some of the high points of your article, which was basically breaking down the steps that you take to evaluate a bank stock.
Sure. I've got my cheat sheet here so I don't forget. But basically, you know, banking's very complex, right? And you can kind of get lost in the weeds. You know, every little metric, and say, oh, well, what's its... Yeah, I can't even think of
Tier 1
Thank you.
leverage ratio.
Tier 1.5 ratio to Tier 2 liquidity.
What was
you know,
that during Basel II?
right? So you need a framework, and just like in any part of investing, something to kind of keep you honest and to keep you. This is what I really care about. This is what I don't.
Do you ever call it a mental model?
I don't, but you could.
Okay.
You could. Yes. So for me, there's four things, just basic things you want to do in a bank.
Okay.
You want to see what it does. You want to see its price, you know, how much you're paying for it. You want to see its earnings power, and you want to see the risk it's taking for that earnings power.
Okay.
Now, I mean, that's a pretty broad framework, but you know, if we're stepping through each step, you can look at, you know, for what it does. The most important thing for a bank is it's taking in deposits and it's giving out loans.
Right.
The higher the percentage of deposits as a percentage of your liabilities, the more of a real bank you are. Right?
Yeah, I like that you brought that up first, that it was first taking the deposits and then making the loans, because I think a lot of people focus too much on the asset side of the equation, whereas a lot of the value in a bank is created in the liabilities in those deposits.
Right, because if you don't have those deposits, right, you have to pay more for, because a lot of people, you're paying nothing for a checking account a lot of times.
Yeah, so you can go through those deposits and figure out what's non-interest bearing, right? So you can look at the low interest bearing, maybe the savings accounts, and then compare that to brokered CDs and that kind of thing, which is typically higher cost for a bank.
Right, and then you can look at that as a percentage and see if, oh, are they taking on a lot of debt? How much are they paying for the debt? And all of that. And then on the asset side, similar ratio. You want to see your loans as a percentage of assets, because if you're not putting out loans, then you're probably buying securities or doing something else with it, and that can be good or bad. A lot of the things in this article, point out it's very hard to say this is
Not
definitively
one right
bad.
answer.
Like bad debt's generally bad,
Yeah.
right? But these kinds of things, so for example, you could have a bank that is hot, close to 100% of its assets are loans. And that can be very good. They're lending, they're doing what they want, maybe they're dominating their market, and people are coming to them and they're getting good rates.
Sure.
Maybe you have someone who has 60, 70% of their assets are loans. Well, they might be saying, well, this is a frothy market and we can't get good deals, so we're going to do something else with the money and then come in afterwards.
Okay.
So it could go either way, but you want to know what your bank is doing. And then also, when you look at the loans, you want to drill in a little deeper, just like you do with the deposits.
Sure.
You want to look in and say, oh, well, what are they doing? Are they doing commercial loans? Yeah, are they doing single-family loans?
Multifamily.
How much real estate are they versus non-real estate? Do they do credit cards? What are they doing?
How about the non-interest side of the equation?
In
The
terms-
non-interest income.
Sure.
So
So yes,
this-
on the income statement,
So
right?
that would be getting away from the
Yes.
balance sheet now in terms of, I'm thinking in terms of, so what does the bank do?
Yes. So yes, those were balance sheet metrics. Now on the income statement, most important thing is the easiest way to differentiate banks is how much interest income do they have, how much non-interest income do they have. So for example, in my article, the bank I used was Fifth Third Bank.
Okay.
I chose it because it's a big bank, but it's not quite as big as it's too big to fail, but it's not so big that everyone's heard of it, right?
And it's not
It's a tenth of the
ultra-complex.
size, yeah,
Okay.
of the Bank of Americas and Citigroups, and it's got I think it's got 12 states, 1,300 plus branches, so it's a good size, and it sticks to its knitting. So when I show the balance sheet, it's at least somewhat comprehensible,
Right.
Because you want it for explanatory purposes. But for them, they're about half and half.
Yep.
So again, it can be good, it can be bad, right? Because if you're interest rate dependent, well, when interest rates fluctuate, things are going to change. If you're not interest rate dependent, well, regulatory issues we saw with Dodd-Frank, you can get dinged,
Right.
or you can get helped.
I found generally, this is very, very broadly, it seems like a lot of the bigger banks have a similar split like that, a 50-50 split between interest and non-interest income. US Bancorp, for instance, has the very big merchant processing side of its business, which brings in a lot of reliable non-interest income. But I think as you get into the smaller banks, which I know you like to dabble in the smaller banks, you can see a much different split around the interest and non-interest income. And in particular, I think you generally will see a higher percentage of interest income. Has that been your experience?
I have to get my spreadsheet out, but it makes sense, right? Well, especially when you get to the really big folks who there's just, like a JP Morgan or something. There's a lot of stuff. So yeah, I think in general, your point, absolutely.
So getting on to price now, I think when we think about valuing, or when a lot of investors think about valuing a stock, they're thinking first about price to earnings ratio. But I know that that's lower on your list in terms of how you're thinking about banks.
Sure. I think, for most bank investors, the big kahuna is price to book. And then if you get a little deeper is, the deeper tracks, well, I used to be price to book, now I'm price to tangible book.
Right.
That's one step deeper. And the reason you'd use tangible book is just to take out something like goodwill,
Right.
which you're kind of rewarding a bank for overpaying for acquisitions by including goodwill.
Say Bank of America, buying Merrill Lynch. The Merrill Lynch acquisition put a whole bunch of goodwill on Bank of America's balance sheet, and even going back further, Bank of America under Ken Lewis did a lot of acquisitions, so ended up with a lot of that goodwill on its balance sheet. So
to play devil's advocate on that, I mean, the banks are supposed to evaluate the goodwill, and if it needs to take an impairment, they're supposed to do it and work with the accountant. So you shouldn't completely say goodwill is worth nothing.
But it's not an earning asset.
Right.
You can't say that this is something that you can't lend out goodwill.
Right.
I mean,
it's a liquidation.
I'm just saying it can
right?
change.
Yeah.
I mean, theoretically, your book value is protecting you in a liquidation type of scenario.
Right.
And goodwill.
Yeah.
It's nice when you can share goodwill with people, share goodwill with the world.
Right. And I'm not denigrating price to book. I like to look at both.
Okay.
Especially when you're trying to convince yourself of it. It's nice to be able to say, oh, X bank is under book value.
Right.
It's like, oh, it's 10% above tangible book value. It's not as
So
fun to say.
is there any sort of rule of thumb you use as far as this is when a bank is cheap, this is when a bank is expensive?
Sure. The industry, jargon one is you buy it half of book value, you sell it 2 times book value. I think anything under, well, it depends on when you're talking, right? In 2009, you saw a lot under book value.
Right.
Now it's less common. So I think anything under 1 is always interesting.
Okay.
Anything over 2, you start to, but again, it's some banks will always be that because they can then, we talk about the next step, which is the earnings power. So a lot of times you see that, just like when you look at price to book and price to tangible book,
right.
When you see that difference, you want to see, oh, well, how did they get their goodwill? Like in Bank of America's case, you got Merrill Lynch.
Mm-hmm.
You want to understand the differences and why that is.
Sure.
Because you might see something where a tangible book's much higher, but you say, well, no, I believe in that goodwill. That's going to generate more income. And you can also see a differential between the price to book and the PE ratio.
Mm-hmm.
When you've got a very low PE ratio but a high price to book, well, that bank is able to generate a lot with its book value. So
on that note, let's talk about earnings power.
Sure. So with earnings power, the traditional one is return on equity. Mm-hmm. And kind of the standard there is, for me, it's 10%.
Okay.
That feels if you're above 10%, that's good. If
You're
you're
doing
below,
well. If you're below, you're
not so
you're
good.
laggard.
And again, with all of these, it's
Sitting in the corner with the dunce cap on.
Right, exactly. And with all of these, like we said before, it totally depends on the market cycle, and a lot of it's a relative. Well, you want to look at a relative valuation, but you also want to have some absolute standards because otherwise, when the market gets super frothy and you just do relative differences, you get in trouble, right?
Right.
So absolutely return on equity, and then you want to look at other things like your net interest margin, and you want to look at your efficiency ratio. So efficiency ratio, right, is basically how efficiently you're running your operations. Net interest margin, how much you're making on your deposit to loan
How big
spreads.
of a bite the costs are on what you're actually earning.
Right.
So
or on the efficiency side, right?
Yeah, like a golf game, the lower your efficiency ratio, the better.
Right. Ideally, and like with golf, if you're under 70, that's pretty good, right? Above 70, not as good. I mean, for us, for me, under 140.
Well over 100.
Yeah. The golf analogy only goes so far.
So when it comes to, well, actually, first let me ask you: do you ever use return on assets? Because I look at that sometimes as sort of an unlevered view on the earning power of the bank.
Yeah, if you looked at my scrap Word document before I published the article, that was one I wanted to include. But for simplicity, there's so many metrics. But absolutely, return on assets. So why you'd want to use return on assets versus, well, again, you want to compare that to the return on equity. And why you'd want to use it is you want to see it regardless of how much equity and how much leverage you're employing to get that return on equity, right?
So we've been talking about Bank of America a bit here. So how do you think about a bank that's currently showing lackluster earnings power, like Bank of America, but has the potential to improve that over time, get more efficient, improve that efficiency ratio, reinvigorate some of its business lines? Do you consider something like that, or are you primarily looking for banks that are hitting on all cylinders right now?
Sure. I guess I like to talk out of all 3 sides of my mouth. Yeah. But
that works here. That's usually what I'm doing, and then David's calling me on it.
Right. So personally, in the current environment, normally I like to stick with the numbers on banks, just because if you've ever read through a bank's earnings release, I know you guys do, or their 10Ks and stuff, every bank sounds amazing.
Right.
You know, if they're doing badly, oh, well, that was in the past, or prior management, or same management, but somehow they've learned their lesson and they're going to do better this market cycle and things are changing. It's so hard. So the numbers, I like to rely on the numbers primarily.
Okay.
But you mentioned Bank of America. I have a special case, right, with the larger banks, which you've got that too good to fail cushion, however much that helps, you know. Well, I mean, there's a smaller bank, you're kind of on your own.
Yeah.
You don't, you know, you're like a kid with no parents to go to help. You know, Bank of America's got daddy government to kind of help out.
Yep.
You know, so with them, and there you have to give more of a leap of faith because of the complexity, right?
Okay.
I mean, I am a Bank of America owner, so yes, with a Bank of America or a Citigroup, I do buy that
Willing
they
to
will
look on the-
they will get to mediocrity.
Okay.
Right.
And mediocrity would be great for the two of them.
Right.
Finishing out, you have a final section on risks to earnings power, correct?
Right.
Okay.
So when we were trying to think of crazy banking terms, you threw out a tier 1 type of ratio, and I mean there's like 15 tier 1 type of ratio, you know, with tier 1 in it specifically, and then all the other ones that they're just very confusing.
Yeah.
You know, I talked in the article about the stress and the stress tests. The Fed looks at 5 different ones, and I mean the first 2 sound exactly the same. I always have to go to the actual definition. Okay,
Oh,
that's
yeah,
a slight.
that's how it's different.
You know, but there's a very basic one you can kind of do, and it's the assets to equity. You just want to see. You know, so the easy way to think of it is when you're buying a house, you put a 20% down payment, which is your equity, right?
Unless this was 2006.
Right. You put a 1% down payment.
1%.
And then your asset is your house.
Yeah.
So your asset is 100, and your 1% down payment's 1. So that's 100 to 1.
And by 100, you mean
Leverage.
$1 million house.
Right.
$1 million house, 1% down.
Right. You put whatever 1% a million. Put $1 down. Less than 1%. But back then. But so getting back to the 20%,
Right.
you put 20% down. That's 5 to 1. Your house is worth $100,000. You're putting down $20,000. So with a bank, personally, I like to see 10 to 1.
Okay.
You know, they can take a little more leverage. When you get above 10 to 1, you start worrying a bit. Now, you know, when you get above 10 to 1, that juices your return
Right,
on
your
asset,
return
and you'll
on
see a
return
great
on-
return on equity.
Yeah.
Right.
And an example of that is if you look at Wells Fargo compared to some of the Canadian or Australian banks, Wells Fargo has a return on assets around 1.5. The Canadian and Australian banks around 1, but then the return on equity is the same because the foreign banks are using a little bit more leverage. That's where it shows up. as an
Right.
example.
And so if you only look at return on equity, you know, the earnings power, you say, this is great.
Yeah.
Well, this is that counteracting
Sure.
part. So if you're below 10, it could be an opportunity. Or you could be, some banks, they're just so conservative, you want to kick them and say, come on,
Too
make some-"
conservative to ever actually make money for their shareholders.
Right, that's what you want to guard against. But in especially, you know, in a frothier market, it's nice when you see 7 to 1,
Yep.
and you can, and you know, same thing on the other side. If you see 15 to 1, and you see a great ROE, you worry about
So
it.
would it be fair to say that maybe 8 to 12 would be sort of a sweet spot kind of range?
I think that's reasonable.
I'd actually done. I agree with you 100%.
You're setting yourself up.
Yeah. I look at it. I look at it flipped. So equity is a percentage of assets, but it's the same measure. And I'd gone back and looked at and ranked the banks, the big banks, prior to the financial crisis, to see how they stacked up on that measure. And wouldn't you know it, I mean, it was basically exactly in line of who got in trouble. Citigroup, low equity to assets. Merrill Lynch, low equity to assets. Lehman Brothers, low equity to assets. JP Morgan, higher equity to assets. Wells Fargo, even higher equity to assets. So yeah, I think it's a measure that works. It may not be what the regulators are focusing on, but from an investor's perspective, I think it gives a lot of information.
Yeah, there's a similar thing one time, looked at Wells Fargo and Lehman before Lehman went out of business, you know, like 5 or 10 years beforehand. And return on equity wise, I think Lehman was a little better than Wells Fargo. But then when you looked at
happens
the
when you put
leverage
30
at
to
31,
1.
right. And you see like Wells around, you know, whatever it was, 10 to 1
Yeah.
versus 30 to 1. Well, yeah, that's what happens.
All right, getting on to our game for today. This is our new favorite game. It is 10 questions. We've got you here. You haven't seen any of these questions.
All right.
And so you're just going to have to be on your toes. I will start you
Rapid
off.
responses.
Yeah, rapid responses.
Okay.
Yeah, you don't need to give us.
Dumbest thing that comes to my head.
Exactly. That's what this show is all about, saying dumb things. So, first question, favorite big bank stock?
All right.
Think about it.
For value, Citigroup.
Okay.
AIG in 5 years, good, bad, or mediocre underwriter?
Oh. Well, I own AIG, so I'm hoping mediocre to good underwriter.
Best banking CEO?
I'll say, well, not Jamie Dimon.
Not Jamie
Just because
Dimon.
I think he's a little overrated.
All right.
I'll say that.
Burger or hot dog?
Ooh, both? Can I do both? I like the taste of a hot dog, and you don't get it as often, but a burger is going to satisfy your hunger.
What you need to do is do like the cronut thing with burgers and hot dogs.
Ooh.
I just made you a billionaire right there. Next question, if you could magically make one bank 20% cheaper, what would it be?
Oh. Probably be a smaller bank. If we're talking big banks, something like
it
a
could be-
Wells Fargo.
no, it could be a smaller bank.
Smaller banks, or U.S. Bank.
Okay.
Any of the good banks, right?
Okay.
Like a BB&T. I've been waiting for that one to fall, under say $30 a share for a long time now. So Fifth Third Bank
Hit
I
it
talked
with that
about.
20%.
Pretty much any of the banks, like a PNC Bank's
Okay.
doing better. Any of the better banks, give me that 20%.
All right.
We just talked about Jamie Dimon. Will he still be running JP Morgan in 2016?
Yes.
Okay.
Taylor Swift or Selena Gomez?
Ooh. I enjoy both of their works. Matt and I both have this problem where we like pop
Hey,
music.
don't throw me under the bus here. It's true.
See,
but don't throw me
so
under the
Taylor
bus anymore.
Swift, she's got like 22, fantastic. We'll do that on infinite repeat.
You're
Selena Gomez has some,
overthinking.
Taylor, even though she gets annoying.
Breaking Bad or The Wire?
The Wire, best drama ever.
The most overrated bank?
Oh. Well, it was J.P. Morgan before the whale situation. I'll say a Goldman Sachs just because it's such a master of the universe type of place. So I'll say that just for that. And plus, I generally don't invest in the investment banks just because, the other, the hybrid ones, I at least can fool myself into looking at their regular operations and
Black
knowing
box.
what's going on. Yeah, I'll say that.
Final question.
When you see a 10% dividend yield, are you excited or scared?
In the past, excited, now scared. Just because, with knowledge comes scaredness.
Exactly.
Nice work. Second go round of the 10 questions on, and you nailed it.
Who was my predecessor?
Morgan yesterday.
Oh, okay.
Yeah, Morgan did pretty well, but I think he would have tried to take a pass on the Taylor Swift Selena Gomez question.
Oh, yeah.
And you.
That's my
He
wheelhouse.
did take a pass yesterday. He passed one of our questions.
Yeah, he actually did take a pass. But you not only answered that question, but overthought it, which is fantastic.
Right.
We have an email address. That email address is WTMI@fool.com. We love getting questions and comments and corrections, if you have them, to that email address. We have a question today from Max. Max writes, I have a very wonky question, but I cannot really reconcile this in my head. If the federal government stopped running a deficit and no longer issued T-bills, would that lower rates that private corporations pay for debt due to a reduced supply of bonds? That should spur the economy due to the cheap cost of capital for private industry to hire and grow. David, what do you think?
Interesting question. Is it like, do we think that would happen, or what if it happened?
Okay, well, I'll take a shot at it, and then you guys can tell me why I'm off base here. We'll call it a $600 billion deficit for starters. I think that kind of straddles the last deficit in the
Surplus or deficit?
Deficit.
He's asking
now.
about a surplus, though.
No, he's
For now.
right now,
Okay.
in reality, in real life, David.
Okay.
So let's call it a $600 billion deficit. I think, first of all, we don't have to assume that the deficit goes away for this scenario to play out, because any amount to which the deficit is reduced, the government would have a reduced need to issue bonds. But even if the deficit was reduced, I think it's important to point out that bond issuance wouldn't dry up, because it's sort of like a ladder with the government bonds that are outstanding. So they're constantly maturing, and so the government will still have to issue them. So what we're talking about is fewer bonds being issued, which could have that sort of effect, where if there's appetite in the bond market for fixed income securities, and there are insurers out there are hedge funds, there are PIMCOs of the world who need to buy fixed income. So that could happen. So we could see lower rates on corporate debt. But I was looking at some of the recent bond issuance. So Nestle just sold $650 million of 6-year bonds. Had a yield to maturity of about 2.2%. GE Capital sold $1 billion of 3-year bonds, basically at par, 1.25%. And Prudential Financial sold $700 million 10 years with a yield to maturity of 3.56%. So my question is, even if you had that happen, even if the cost of capital came down, the cost of debt came down a little bit for private industry, is that really going to further spur? When you see GE Capital getting 3 years at 1.25%, is a little bit cheaper really going to suddenly have everybody say, oh, now we need to issue debt?
But would private companies be paying a cheaper rate than the government? Could that be possible?
It's happened for some governments. When I was looking for some more information on, I think it was the Prudential or maybe it was the Nestle issuance from a couple of years. There's an article on Bloomberg a couple of years back talking about how Nestle was paying a lower rate than France. So France was paying more for its debt than Nestle was. So
I was saying the U.S. government.
Yeah.
So
I guess just to address the wonky question, right? We'll use the jargon term, right? So he's basically talking about the opposite of the crowding out effect in econ, where the government competes with businesses for debt or for actually producing things. So he's saying, well, what happens if that shrinks? And maybe I think it would be a more interesting question if interest rates weren't so low, as you said.
Yeah.
And personally, one thing, it never works how you draw it out in an econ thing. But
a lot of moving parts.
Right. But getting away from the econ into the actual brass tacks of running a business, personally, the bigger danger to me is that interest rates are too low for businesses to, the hurdle rate that they're using can be so low that you take on stupid projects, right? And you waste money. I feel like there's a golden mean level where you have to at least think about it before you get some debt, and you're worried about paying it back, so personally, yeah, maybe that happens, the negative crowding out. And I don't even want to think if the government didn't have any debt, because then you have other market effects.
Well, I totally forgot the other side of the equation that I was thinking about is that, again, if we argue that the deficit totally goes away, so there's the question of how much additional borrowing goes on, and then how does that borrowing flow through the rest of the economy? But you've just had $600 billion that's no longer being spent. And that's not money that's maybe being spent, that's held somewhere, that's been financed, and who knows if that's money that's actually being spent by the government. So I think on balance, if you had that happen, if the government decided, okay, right now, today, we're going to balance the budget in order to try to lower rates for corporate issuance and hope that spurs the economy, I think you're going to have a much larger, much worse effect from the pulling out of the $600 billion than you will have from the spurring from lower rates. That's my take.
Fair.
All right, finishing off the day on the Twitter sphere. David, what is the first tweet?
First and only tweet is from MarketWatch. It's an article. They have 5 secret stocks you need to know about for 2014. I didn't even open the article, but the tweet caught my eye, and I was curious.
Now we want to know.
I have to find it. I was curious if Anand has any secret stocks on his radar. Not that you don't even have to like the stock, just a company that people don't talk about a lot that you find interesting. And if you don't have one, I'll put Matt on the spot.
I did a write-up a month or two ago on the Container Store. Now it's not hidden. I guess certain parts of the country it is hidden because it's still expanding. It's a small cap. It's the Container Store. If you're not familiar with it, they do containers, of all different boxes. It's one of those
mostly
companies.
Made out of wire, mostly way more expensive than wire.
They need to be.
Containers need to be.
Right, and that was my going in. But we've had the CEO, Kip Tindall, come in, and that was a few years ago before they were public. And I got more and more impressed. And when I finally dug into them, I'm kind of a. This is one of those that, could be one of those David Gardner rule breakers type of stuff. Well, when I analyzed it, I was kind of like lukewarm. I bought a little position. That was when it was in the low to mid 30s.
What's the overall market cap right now? Do you know?
It's like 1.2 billion.
Okay.
Roughly.
Yeah.
Under $2 billion.
Yeah, that sounds right. I haven't, because it's fallen a little from when I looked at it, because now it's in the high, mid to high 20s.
Okay.
So, which is good for me because then I could add in.
Right.
But that's something to start looking into. But the problem is with them is one of the big concerns is they have so much debt. So they could be a small cap with a lot of debt can be very volatile.
Yeah, sure.
So we could, I said before in the 30s you could see better prices. It's still possible today, but that's why I'm kind of buying slowly. But that's a hidden stock.
Cool. Did you have one, David?
No, I didn't have one.
You didn't have. You just.
You didn't read the article.
I always do that. I never have the answers to anything.
All right. Well, on that note, we'll end the show there. You can find us on Twitter at TMF Financials. You can also find us on iTunes, Stitcher, and Swell if you want to listen to the audio version of this. I'm Matt Copenheffer. Yeah, this is still David Hansen. And over here, our special guest, Anand Chakavelu. Thanks for joining us. We'll see you tomorrow.